Gold fell almost 8% in a day and kept sliding, while the whole world was watching it as the last safe asset. In the space of 48 hours, the price went from above $5,300 an ounce to roughly $4,500, and silver dropped from triple digits toward the 70s. That is not a rounding error. That is a regime shift in the way most people think panic works. They said this could never happen. They said when stocks shake and headlines turn dark, gold does one thing. It absorbs fear. But the market just delivered a different message. Gold fell as risk assets wobbled. The US dollar firmed at the same time. And the rules of leverage were tightened after the plunge, raising the cost of holding futures just when traders were already underwater. It looked like the safe haven itself became the source of stress. Here's the uncomfortable part. When moves like this happen, it is rarely because the world suddenly decided gold is worthless. It is almost always because someone, somewhere, needed cash more than they needed a hedge. The price doesn't fall because the story changed. It falls because the balance sheet changed. And balance sheets do not change evenly. Institutions move first. They don't wait for consensus. They don't wait for the evening news to tell them what just happened. They read the plumbing. They watch collateral. They watch the funding markets. They watch how quickly a crowded trade can turn into a stampede the moment the rules of leverage are adjusted. What I'm about to lay out is not a prediction. It's the mechanics behind a contradiction that seems impossible at first glance. Why the asset designed for crisis can drop right when crisis is supposed to be its moment. And once you see the pattern, you start noticing it everywhere. Welcome to Channel Name. This is where we decode what matters before it becomes a headline, using market structure, exchange rule changes, and the data that sits behind the price. If you like analysis that stays calm when the tape gets loud, consider subscribing the way you'd. Keep listening to that one wise elder who never raises their voice. And tell me where you're watching from in the comments, because the way this hits you depends on your currency and your local market. Now let's reconstruct what actually happened, step by step with numbers. On Thursday, January 29th, gold and silver had already begun to wobble after running hot. 4% to around $5,164 an ounce, from near $5,600, and silver fell from around $109 after its own surge. That was the first crack. A market that had been behaving like it could only go up suddenly realized there were sellers at size. Then Friday, January 30th, the trap door opened. Gold dropped roughly 7 to 8% in a single session, one of its worst one-day hits in more than a decade. Silver fell even harder, well into the mid-teens, and in some widely watched quotes, the intraday damage looked even more violent. Mining stocks were hit, as if the metal price had permanently reset. Double-digit declines across the sector became normal for that day. And then, instead of a clean bounce, the stress rolled forward into the new week, 4% to around $73. When you combine those moves, you're looking at an air pocket large enough to force positions out of the market, not just shake out weak hands. If you've watched gold for years, you know why that is so strange. Gold can be volatile, but its volatility usually behaves differently than a high beta asset like silver or a tech stock. Gold is supposed to be the ballast. And yet, in the exact moment where the narrative was uncertainty is rising, gold behaved like a position that had to be liquidated. At the center of the drama was a sudden shift in expectations about monetary policy. The market had been leaning into a very specific story, a weaker dollar, looser conditions, and a continuation of the debasement trade, where hard assets rise because paper promises look fragile. Then a catalyst hit. A new Federal Reserve Chair nomination, widely interpreted as more hawkish than investors had priced, jolted the rates and dollar narrative. The dollar strengthened, even if only modestly on the day, and the reflexive trade kicked in. Sell what benefits from a weaker dollar, and buy what benefits from tighter policy expectations. But that is only the surface layer. The deeper layer is what the market reveals when you look at positioning and leverage. When a trade becomes popular, it doesn't just attract believers, it attracts borrowed money. The futures allow a trader to control a large notional value with a fraction of collateral. That leverage can be a tool or it can be a trap. And in late January 2026, precious metals had become more than a hedge. They had become a crowded expression of macro anxiety, traded aggressively across funds, desks, and systematic strategies. One of the clearest pieces of evidence is what happened right after the plunge. CME Group, the exchange at the center of U.S. futures trading for gold and silver, announced margin increases in response to the volatility. For non-heightened risk profiles, gold futures margins were raised to 8% from 6%, 1% for heightened risk profiles. The exchange framed it as a normal review of market volatility designed to ensure adequate collateral coverage, and the timing mattered. The change took effect from Monday's close, right as traders were trying to stabilize. Those numbers matter because margin is not opinion. Margin is the price of leverage. When margin rises, the same position requires more cash to hold. And when the market has just moved against you, the demand for cash becomes immediate. That is how selling becomes forced selling. You could see the stress in the raw futures tape. 35% drop, with volume near 494,000 contracts. That is not a quiet hedging market. That is mass repositioning. When that much notional exposure changes hands, price stops being a calm vote on value and becomes a clearing price for risk. It is the number that forces accounts to square up at the end of the day. It also explains why silver, with higher volatility and higher margin, tends to overshoot on both the way up and the way down. In that environment, even safe can trade like a fire sale. Now zoom out and you'll see something else. It wasn't only the US futures system reacting. In India, the multi-commodity exchange revised its own framework. Gold bullion margins were set at 20% with an upper cap of Rs 400 crores per member, and silver margins at 25% with the same Rs 400 crores cap. Just weeks earlier, the cap had been Rs 200 crores. That is a doubling of the ceiling on how much margin can be demanded per member. 50% on silver near-month futures, showing how fast exchanges can alter conditions when volatility erupts. Think about the sequence. First, price drops. That triggers risk models, stop losses, and volatility-based reductions. Then margin rises. That forces collateral calls. Then more selling occurs to raise cash. And that second wave can happen even if the original catalyst is already fading because the system still has to rebalance. This is why gold can fall during panic. Not because it stopped being gold, but because it became collateralized exposure inside a leveraged ecosystem. Now here's where it gets interesting. This isn't new. In 2008, during the heart of the financial crisis, gold did not simply climb in a straight line while everything else burned. In the initial phase, when funding markets seized and margin calls spread, investors sold what they could, not what they wanted. Gold was liquid. Gold was widely held. Gold could be sold quickly to meet obligations elsewhere. That forced selling knocked gold down even as fear was rising. Later, once the liquidity scramble eased and policy response broadened, gold resumed its role and eventually moved higher as the crisis turned into a currency and balance sheet story. In March 2020, the same thing happened in compressed time. The world shut down. Equity markets crashed. And gold futures experienced some of their largest single-day losses on record in back-to-back sessions. That confused people until you looked at the mechanics. Funds were de-risking across the board and gold was being sold to raise cash. Then, as the policy response arrived and the initial liquidation wave ended, gold recovered and later moved to new highs. In 2026, the pattern is appearing again, but with an extra layer. Gold and silver weren't just insurance policies. They were crowded trades. Gold had surged more than 60% in 2025, and it was up more than 20% early in 2026 before the air pocket. When a position has those kinds of gains, it becomes a natural source of liquidity when stress hits elsewhere. In other words, gold can become the piggy bank. So let's talk about the players, because the players explain the behavior. On one side, you have the long horizon institutional buyers whose time horizon is measured in quarters and years, not minutes and hours. Central banks have been a dominant force. 3 tons of gold. Poland alone added 102 tons. 6 tons to 200 tons, lifting gold's share of its portfolio dramatically. These are not traders chasing a candle. These are institutions treating gold as strategic reserve logic. Alongside official buyers, investors poured into gold as a financial asset. Investment demand in 2025 surged 84% to 2,175 tons. Total gold demand topped 5,000 tons, with total value around $555 billion. Gold-backed ETFs saw strong flows, with holdings increasing by 801 tons. And Q4 demand coming in at 1,303 tons, the strongest quarter on record. They are the numbers of a market that has become central to how investors express uncertainty. And yet, even inside those bullish demand numbers, there is a fracture that helps explain the volatility. Jewelry demand can weaken when prices rise too fast, 5 tons. The value of jewelry demand still rose because price rose, but the volume dropped. That tells you something about who is buying, not the traditional consumer, but the financial buyer. Now contrast those long horizon buyers with the other side of the market. Leveraged speculators, systematic funds, and short-term traders who treat gold and silver as liquid macro instruments. They move fast. They respond to volatility. They often hold baskets of trades linked by risk models, not by stories. When the debasement trade was working, these players piled in. Gold, silver, miners, and related derivatives became correlated expressions of the same belief. And when the belief was challenged, the whole basket could be unwound together. That's why miners can drop 10% when gold drops 8%, even though a mining company is a long-duration operating business. In a forced unwind, nuance doesn't matter. Liquidity does. Now, if this were only about a hawkish surprise and margin mechanics, the story would end there. But the real story is the dislocation, the part where the data shows two different realities at the same time. Here is the dislocation. Paper prices were collapsing, while physical and structural signals were flashing tightness and long-term accumulation. Start with geography. In periods of stress, the East and West can trade the same metal at meaningfully different prices, because physical demand, import rules, and local liquidity do not move in sync with futures positioning. In recent weeks, analysts noted that physical silver in Shanghai traded about $6 per ounce, above paper benchmarks, a premium that implied physical tightness even as paper markets were dominated by speculative flows. $6 might not sound like much, until you realize that on a $100 metal, it is a meaningful percentage gap. And that gap exists because physical and paper are responding to different constraints. Futures markets can move billions of dollars of notional exposure in minutes. Physical flows move slower. Central bank purchases are reported with lags. Sovereign funds can buy quietly. And demand can shift from jewelry to bars, from coins to ETFs, from retail to institutions, without changing the metal's role. The data in 2025 shows exactly that. Central bank buying slowed by about 20% compared to the prior year, but investment demand exploded. That means the marginal buyer was no longer just official accumulation. It was private capital pouring in through market instruments. So when the shock arrived, the price responded like a financial instrument, not like a vault asset. This is the part no one is discussing. A market can be structurally bullish and still experience violent sell-offs if the leverage sitting on top of it becomes unstable. The longer the trade works, the more leverage it attracts. The more leverage it attracts, the more fragile it becomes. And when the rules change, it can unwind faster than the underlying fundamentals ever could. Let me show you what that mechanism looks like in plain language. Imagine a crowded theater where everyone is standing on chairs to see better. As long as nothing changes, it feels fine. But if a few chairs wobble, the people on chairs are the first to lose balance, and their fall knocks into the people next to them. It's not that the stage disappeared, it's that leverage amplified the motion. In futures markets, margin is the chair. When prices rise, traders feel stable and often add exposure. When prices fall, the same exposure becomes heavier. Then the exchange raises margin because volatility increased. That forces traders to either add cash or reduce positions. Many reduce, not because they no longer believe, but because the chair got taller while the floor started shaking. Now layer in how modern portfolios are actually run. Trend-following systems reduce exposure when momentum breaks. Volatility-targeting funds reduce exposure when volatility spikes. Risk parity strategies rebalance when correlations shift. And many macro funds hold precious metals as part of a broader basket: commodities, currencies, rates, and equities. If the dollar strengthens at the same time and rates expectations shift, commodity exposure can be reduced across the basket. These strategies don't need a dramatic headline to trigger, they need signals. And when the signals flip together, you get synchronized selling. You also get something else. The safe haven gets treated as a funding source. If a fund has losses in equities, credit, or crypto, it may sell the positions that are up the most to raise cash. In late January, gold and silver had been among the biggest winners in the global market complex. So when stress hit, they became the easiest place to harvest gains. The day is not about safety, it's about cash. And that brings us to the contradiction inside the contradiction. If gold is a hedge, why did the dollar strengthen while gold fell? Because safe haven is not a single concept. There is safety from inflation, and there is safety from margin calls. When the market is deleveraging, the most immediate haven is cash and cash-like assets. The dollar is the settlement currency for much of global finance. When everyone needs to post collateral, the demand for dollars can spike, even if the longer-term story is negative for the dollar. That dollar spike can pressure commodities priced in dollars, including gold. In other words, gold can be the hedge against what comes after the deleveraging, while the dollar is the hedge during the deleveraging. Timing is everything. You can see the broader cross-market echo of that dynamic in the numbers that appeared alongside the metals move. Equity markets weakened. 6% on one of the heavy days, and US and European futures softened. 22%, reflecting a bid for duration, while the dollar ticked up. In other words, the market was not delivering a single clean story. It was delivering a collateral story. So what does this mean from here when you strip away the noise and focus on patterns that have repeated? Historically, this setup has led to one of three broad outcomes, depending on whether the underlying stress is transient or systemic. In the conservative scenario, the sell-off is a violent reset of positioning. Leverage gets flushed, margin hikes do their job, volatility compresses, the dollar's spike cools. Gold stabilizes within a new range, and the market spends time digesting gains rather than extending them. In this world, gold behaves less like a rocket and more like an asset rebuilding a base. In the moderate scenario, the liquidation is followed by policy signals that reintroduce the original drivers: fiscal concern, real yield pressures, and renewed investment demand. If those forces persist, the historical pattern is that gold can recover after the initial shock and resume its role, not immediately, but after the system stops selling for cash. The recovery is often slower than people expect because confidence has to be rebuilt and positions have to be reconstructed with less leverage. In the aggressive scenario, the sell-off is not isolated to metals. It is a symptom of deeper instability and leverage across markets. In that world, forced selling spreads, correlations rise, and the policy response becomes more dramatic. Historically, when that happens, gold can first fall with everything else and then rally hard once the liquidity wave passes and the focus turns to currency credibility and balance sheet expansion. Notice what all three outcomes share. The initial move is about mechanics, and the later move is about macro consequences. So, what signals matter if the goal is to understand, not to guess? Watch how margin policy interacts with volatility. When exchanges raise margin and volatility remains elevated, leverage is still being unwound. Watch the dollar and real yields for confirmation of whether the funding squeeze is easing. Watch ETF flows and bar and coin demand for whether investors are adding exposure during weakness or whether they are stepping back. Watch central bank data for whether official accumulation resumes or slows further. And watch the spread between physical and paper markets because persistent premiums often indicate a market that is tight in the real world, even when the paper price is being pushed around by forced flows. Here's the final point, and it's the part that separates people who see the system from people who only see the headline. Institutions experience markets as constraints: collateral, margin, liquidity, correlations, funding costs, and the speed at which positions can be reduced without breaking the system. That is why institutions move first. They are not smarter in some mystical way. They are simply closer to the plumbing. By the time the average person hears gold fell in panic, the real event has already happened. Leverage has been repriced, collateral has been called, and positions have been forced to shrink. The wealth gap is often an information gap, not because of secret information, but because of attention. The market telegraphs stress through mechanics before it explains itself through narratives. So the next time you see gold fall when everyone expects it to rise, don't ask whether gold failed. Ask what the system needed in that moment. Ask who needed dollars, who needed collateral, and who had to sell what they could, not what they wanted. This is Channel Name, where we decode what matters before its headlines. If this connected dots you hadn't seen, you know what to do. The question isn't whether markets will keep testing assumptions. The question is whether you'll recognize the pattern before it does.